something stupid there, but there we go. Right, okay, so we're now recording. So I'll start admitting all. Admit all. There we go. Good morning, Peter. Good morning, Chris. Morning, Bob. Morning, Padraig. Thanks for joining. Morning, Henry. Morning, Con. Morning, Derek. Thank you for joining. Morning, Chris. If you've just joined, in the usual fashion, if you could mute, please, that would be great. Morning, Julian. Thanks for joining. If you could mute, please, Julian, that'd be great. Morning, Henry. And yeah, and we've got Bob. Morning, Bob. Thanks very much indeed. If you could mute, Bob, that'd be great, or I can mute for you. But maybe I'll do it. Hang on. Here we go. Here we are. Morning, David. Thanks for joining. Appreciate that. If you could mute, David, that would be great. Thank you. Morning, Derek. Morning, Chris. Morning, JQ. More people joining. Morning, Wilson. Thanks for joining. Thanks for joining. JQ, if you could mute, please, that'd be good. And Mark, if you could mute, that'd be great. Thanks very much. That's very kind. Okay, I think we'll get going now, Peter. There's more. Morning, Charles. Thanks for joining. Okay, so welcome everyone to this week's Coffee Morning with Pension Playpen. Delighted to have Peter on board. Many of you know Peter. I'm sure he'll do a brief introduction of who he is and where does he come from in typical blind date style, but most of you will know who he is. So this week he's very kindly giving us a presentation on shared ambition pension schemes. And this is a challenge to us, I think, as an industry, challenge to all of us on this call. As usual, if you have any questions or would like to ask Peter a question, then please raise a hand. We'll also open the chat room. Also, we are recording, so is everybody happy? Thumbs up. Chris, Peter, everybody's happy? Thumbs up for recording. So we're recording the session. And as I say, I'll monitor the lobby, Peter, and we'll welcome people's comments in the chat as well. So without any further ado, over to you, Peter. I know you've got some slides to present.
Right. Well, thank you very much. Yes, I have a fair number of slides and they're a bit busy, but so I'm going to sort of rattle through them and sort of cover that. But if anyone does have any questions, I should be able to see a raised hand, either electronic or physical, and please do so at any time. Sorry, I've just got to get rid of this thing that's appeared on my screen, which is blocking me from seeing things. But so talking about shared ambition pension schemes, I've been associated with them for 24 years, thereabouts. The
organizer to let you in, and I'm in. Oh.
Right. Right. Okay. Right. Brief interruption there. Yes, I've been associated with them for about 24 years, and as the usual habit of these things, it was purely by accident. My background is I was finance director of a medium-sized not-for-profit organisation, a national body, and I at the time had was self-administering a pension scheme, a final salary, to be fairly typical pension scheme at that period. I then left there, did a restructuring, and I had some health issues and ducked out. And I went to do some consultancy. And one of the organisations that asked me to do consultancy asked me to look at their pension scheme administration costs on a comparative basis, which was a concern and still is a concern to many companies. When I got there, I said, you're asking me the wrong question. What is the cost of your pension promise? They said, yes, we know that people are moving from final salary to DC, but it doesn't really suit our business prospects. And I sort of said, well, actually, I know an actuary who is actually actuary to our pension scheme, who has been doing some submissions to the Department of Work and Pensions on the stakeholder consultation, and would you like to talk to him? And I'm very pleased to say that that actuary, Derek Benstead, is on the call today. So you want to just say hello, Derek?
Hello, everyone. I'm sure I'm pretty well known to most of you on the call, but yes, as Peter said, worked with him on the development of the scheme that he's talking about.
Thanks, Derek. At this stage, I have been requested not to mention the company's name in this context, although it's fairly, most of you, if they do a LinkedIn search or anything like that, will find out what it is. The reason is the company is being trolled by a disaffected person who's picking up any internet references to the company and is then making mischief from them. So for that reason, it's nothing to do with pensions at all. So, but for that purpose, but yes, I will not mention the name in the talk unless I forget. Right. So we came on that, and Derek persuaded the company to adopt what's subsequently termed a shared ambition pension scheme, and which provided various things, and I'll come on to that, the structure of that scheme in a lit. But and that was set up and was opened as a new section to the final salary scheme, which at that time was in a reasonable deficit, considerable deficit, and the scheme is now still open to new. Right. Okay. Right. Okay. Right. Yes. So that was the background. So what I've doing is looking back at it now with my years of experience. I've been talking to other companies about pension arrangements and realised there is merit in this possibility for quite a number of companies. And so I'm asking today to put yourself in the position of a company rather than as a member, an individual of the scheme, to think about it from the company's point of view. Most of the companies that I deal with have had DB pension schemes, usually final salary, which they've closed, but they still have deficits, and or they did until the last valuation, and have sort of struggling with those deficits, and are now contributing for many years into a DC fund, typically a group personal pension fund, with employer contributions well above the auto-enrolment minimum employer contributions. The mean contribution level is about 8% from the employer, 5% from the employee. So they're putting those into group personal pensions, which they perhaps don't really understand. So I've been giving them some background. And why is this not moving on? To right. So talking to them about occupational pension schemes, as I say, these are very busy slides, and I'm only going to pick out a point. But yeah, we're talking here about occupational pension schemes, and in all but the shortest duration, the actual outcome of the pension scheme is most significantly influenced by the investment return the scheme achieves. And that applies in the case of members, in the case of DC, for the employer in the case of DB. So that's the important thing. So if we now look at the history of investment returns, this is the 20-year gilt yields and comparison of the nominal and real gilt yields. You can see from this chart, and I appreciate it's probably the dates are not necessarily very clear, but at the beginning of the chart here, there's a gilt yield of about 8% running up to about the mid-1990s. This is the time when final salary schemes were the norm, and therefore the amount of contributions you had to pay in to achieve a certain defined benefit was lower than subsequently when the yields returned, and investment yields tend to follow the same pattern as the gilts over time. I remember in the 1970s and 80s, 8% gilt yield was deemed a ultra-conservative discount rate, and in fact the pension scheme surplus regulations specified that, and if the pension scheme was overfunded from that, the pension scheme lost its tax-exempt status on investments. So this encouraged employers' contribution holidays at that time. But anyway, we moved on into the late 1990s, and at the same time the government had introduced additional minimum benefits to pension schemes, so they became such as spouses' pensions, indexation, inflation, so the cost had gone up substantially, and then the investment returns went down. And then they stayed in the pattern for quite a number of years, through to 2012 at this lower level of gilt yields between 4 and 5%. And then after the financial crisis, 2008, 2009, the introduction of quantitative easing, the gilt yields deteriorated and indeed went negative, which caused great problems for pension schemes, because then the future liabilities are no longer discounted in evaluation using, if they're index linked, they are actually increased as they go into the future, which made the mortality assumptions, gave them a disproportionate weighting into the pension scheme funding situation. And more recently, we have recovered from the negative gilt yields into, and indeed you probably can't see, but at the moment we seem to be now back at the position we were in from the late 1990s through to the financial crisis. Now, the problem with pension schemes is you're looking at a very long time horizon. If you're talking about current employees, you are talking probably 70 years. It's quite staggering to think that we're talking about pension rights probably beyond 2300 in terms of this thing. And my criticism of the actuarial profession and that sort of thing is that they do a lot of work on assessing mortality by looking at multiple past events, but then they, to my mind, spoil it all by applying a single historic discount rate based on a very volatile market measure, both volatile in the long term and volatile in the short term. So, for example, 6% movements in gilt yields within a day are quite common. That really, to me, diminishes the value of those valuations. And the significance of that is in other schemes. The schemes, we really are looking at long-term investment performance, and LDI, which is trying to match that, my mind, misleading past measure, has caused significant other difficulties. So that's the background. So if we now move on, hopefully, to the employer's pension promise. This is the promise to the points I want. This is a presentation I gave to finance directors, so I just want to peel out. But the outcome from defined contribution, and I think we all know this, the outcome of in terms of the pension income in retirement, and we have this debate about what is the object of the pension pot, but if it's thinking about pension income in retirement, those arrangements are uncertain at the time you're putting in the contributions. So you don't know what contributions to put in to give you a certain rate of retirement pension. but the thing is that the employers are contributing to these schemes, and when the employer, it effectively becomes part of the employment contract, and employers find it almost impossible to reduce the employer's pension contribution if it perhaps is funding for more benefits than they wish to fund. So that would be a change of employment contract and have to go through consultation and a change of employment terms. So that's on the DC side of things. On the DB, it's a promise to provide deferred remuneration by the employer. So basically a pension after normal retirement age, includes additional benefits such as spouses, pensions and such like. That pension promise is part of the employment contract, although the terms of it are usually contained in the pension scheme deed, and employment contracts usually say we provide the benefits as per the pension scheme deed. But that employer's obligation cannot be broken, even though the actual payment of the pensions or benefits are delegated to a pension scheme or to an insurance company. And therefore, to ensure that that pension promise can survive employer failure, the employer puts the money into a trust fund, and that's the thing there. So that's the case, and that goes to the future. So the deferred remuneration promise is, we all know how that's defined. Statute and regulations requires that pension promise to reflect inflation during employment. That's by a link to the current salary in a final salary scheme, or the salary averaged over the whole period of qualifying employment in an average salary scheme. When the pension's in payment and after the employment link has been broken, the annual increases in extent of set statutory minimum rates applicable during the service year. So you always look back to the benefits you gave in the service year, and those cannot be lost, even though they may have subsequently been changed for future years. Under the auto-enrolment regulations, the deferred pensioners can have the same rates of increase as active members. So you can set that up. So the career average revalued earnings arrangements and that. And this is the basis on which the shared ambition schemes are set up. The promise cannot be broken, be altered, and the final one is that discretionary benefits are given that were in the deed at the time of the service year. Those cannot be lost. So the right to have discretionary benefits cannot be lost, even if the pension scheme arrangements have changed. And obviously the fact that you can't change the benefits are subject to court cases such as Virgin Media and such like at the present time. Sorry. All right, now I want to talk about a couple of slides very quickly about the accounting treatment. The accounting treatment is, because this influences the employers quite a lot. If you're looking at DCs, the pension scheme, employers' pension contributions are a cost in the year, and there's no asset or liability created in the company's accounts. And this applies irrespective of where the funds come from. So if you use the surplus on a DB scheme to pay DC contributions, they are still charged in the year into the profit and loss account as a pension cost. That also extends to payments which remove an employer's obligation for a DB pension promise under IAS 19. These are also regarded as a DC contribution, so the full curtailment cost of transferring, and I should emphasise this is my interpretation of IAS 19, but I believe it's also looked at, that the bulk of purchase annuity buyout cost is charged in the year in which the decision is taken to buy out the pension scheme liabilities. And so even when the payment uses the assets of the DB pension scheme, the employer's accounts are hit by the full cost of the bulk purchase annuity. In DB schemes, well, I think I don't really need to cover too much on that. The discounting. The cost taken to the P&L account is the estimated cost of the DB pension promise made to the employees during the year. The P&L account will also have interest to the AA bond rate on the deficit, or if there's a surplus in the scheme, it has an interest credit to the profit and loss account, an income to the profit and loss account. All the other changes to the value of the pension scheme assets or liabilities taken to the balance sheet are taken below the line to the statement of other comprehensive income. So they don't have the same significance as the ones taken to the profit and loss account. IAS 19 also states that where a discretionary power exists, and the example they use is ill health, early retirement, the current year's service cost should include an estimate of the cost of the future exercise of that power. The actual cost, when incurred, results in a remeasurement of the pension scheme liability. And so this also applies to discretionary increases to pension benefits, whether they're regularly granted or on a one-off exceptional basis. In other words, you should cost in the year the expectation of that these discretionary benefits the service year, and you should you then don't reflect the actual cost of the discretionary benefit when you grant it. It's taken down as a remeasurement, just as if the inflation assumption was incorrect. So, and this is not my experience. It's not been widely understood by auditors, who tend to think if you take a decision in the year to grant a discretionary benefit, that surely should be reflected in the year. But the IAS 19 is very clear that that is not appropriate. However, if the benefits are augmented beyond the powers in the deed at the time, so quite a lot of pension schemes with discretionary increases to pensions and payment have a limit reflecting the old in and revenue maximum pension rule that said that the benefit cannot be discretionary powers to the extent to bring the benefit up to RPI over the duration of the pension. So in that situation, if you go beyond that, then that's an augmentation or a change of benefit, and that would be charged in the year. Right, moving on, 5 minutes late. Shared ambition DB schemes, let's talk about them now. It's legally an average salary defined benefit scheme with discretionary benefits. There are minimum standards set by legislation. The pensions and payment, the minimum rate, currently CPI up to 2.5%, annual increases still applies. Active members, their salary is averaged over the whole period of qualifying employment. So the current year's salary is weighted into the average salary, so there is some inflation protection there. And then there also is the revaluation of the accrued earnings, which on a shared ambition scheme is a discretionary rate, at a discretionary rate. Deferred members, and this is where you can, alternative, you can have the minimum rate revaluation, for deferred members, or you can apply the same increases granted to the active members. And in practice, we've used that option in our schemes. That was the position up to 2012, when auto-enrolment came in. Auto-enrolment has a specific section for average salary DB schemes with discretionary benefits, which specifies that the minimum benefit accrual rate should be 1/120th of pensionable salary. The discretionary power to set below a minimum rate revaluation, including a zero evaluation, still exists in any 1 year, but the scheme has to be funded in terms of the statement of funding principles and the technical provision valuations for minimum rate increases in future years. But there is no requirement to make good any previous increases below minimum rate. And more specifically, and this is something that I've more recently come to the conclusion, looked at it again and asked for legal advice, which you get there is no minimum contribution levels. So the 8% auto-enrolment minimum contribution level does not necessarily apply, provided you can provide these minimum level of benefits in a DB scheme or an auto-enrolment scheme. So if you're funded for those minimum required benefits, then the total contributions can be below 8%. So this is perhaps significant in terms of a surplus situation. So there are effectively 3 funding rates for a shared ambition scheme. There is a technical provisions funding rate, which we're all familiar with, and this is used to calculate deficit recovery contributions. And it's based on the key assumption here is that the minimum rate, CPI up to 2.5% funding assumptions apply for future revaluations. So when looking at your future liabilities, you should put that, you have to put that in there. The second funding level is the actual cash funding, which we'll say is represented in the schedule of contributions. Now, a lot of the schemes that I deal with have these sort of fairly generous DC contribution rates. They're also paying deficit recovery contributions into their DB schemes. So they're ending up paying for pension rights twice. It could, my suggestion is that the initial cash funding could match those additional contributions generally, and that would probably considerably exceed the guaranteed benefit level. Now, setting the guaranteed benefit level is probably the most critical decision when setting up a scheme. I think it's Alan Pickering has used the sort of thing, the more you require me to guarantee, the less I will guarantee scenario. So you can perhaps think of that from the employer's point of view, and for example, should you go now, we in the scheme that I'm going to talk about, we initially set the accrual rate as the same as in the final salary scheme, i.e. a 60th of pensionable salary, just for the sake that it's designed to provide the same or similar benefits to members, but gave flexibility rather than that. The other thing is that the benefits can reflect your expectation of investment return. So you can assume that you achieve above the discount rate for the future, if you think that is appropriate. Although that's one of the areas you've got to look at very carefully. You can fund for benefits in excess of minimum rate. So, for example, you could fund for discretionary revaluations without a cap at either some rate, and initially it was thought that should perhaps reflect salary increases. And the full, minor point there, full tax relief is available to the employer and the employee. And on the balance of cost funding arrangements, the future employer funding costs reduce if the investment returns exceed the valuation assumptions after the aspirational benefits have been granted. So, and then the final level of funding is what you're actually aiming to provide to members. And it may be that that is above that which you're funding in the schedule of contributions and further above the technical provisions requirement. But in a stress scheme, if you're not doing that, you can always go back to the zero revaluation for 1 year, just to get deficit recovery contributions under control. If the scheme is in surplus and or the schedule of contributions are providing fundings in excess of the technical provisions current service costs, then the discretionary revaluations can exceed the minimum rate. And I suggest that those should always be reassessed and granted each year with no forward commitment. So say that. But when you're targeting an alternative benefit, the very important thing to avoid creating is a constructive obligation to do that in future years. So what we did in my scheme is made clear that a zero revaluation of the accrued pension rights, this is 2003, was quite possible, and you shouldn't expect anything more. So that slightly changed our view of what the scheme is aiming to achieve over the time, and we're now regarding it more like a with profits scheme. So your revaluations are the share of the profits back to the members, and the company also can share in it in the reduction in the contribution rates. So why is this important? This is typical to all DB schemes or all collective schemes. This very familiar chart, which Derek presented to the board of the company in 2010. I remember it well, which shows that as the scheme is in the early days and has regular new contributions coming in, you are buying assets, and the low market value is good for assets, actually. So as market falls, you're buying more income at a lower cost. As the scheme develops, it carries on, and the contributions and the investment returns are offsetting the outgoings of benefit payments. But if you close the scheme, you lose the contributions, and so the investment returns are the only things that, or investment sales are the only things that are paying out the benefits. So the asset value becomes critical, and that is the only time. So an open DB scheme or any collective scheme, whether pooled, they can, if they reintroduce contributions to that, you reduce your dependency on the asset values and the sale value of the asset values, and either it slows down this required sale of the assets, or indeed you're buying new assets to fund the longer term liabilities that you're now creating. So so the advantages to the employer, and employer's DC contributions are effectively lost money to the employer. It has no interest in them after they've been paid over. The employer needs to consider and review the DC provider's choice. But in a DB scheme, the employer can benefit from the investment return of the employee employer and employee contributions. So both contributions go into that model. In the shared ambition scheme, there's an inbuilt mechanism to share the pain if there is an unexpected deficit situation arises or the investments are not going to generate as much income as expected. But when surpluses develop, the employees can benefit from an increase in benefits above inflation. Market volatilities become much less significant and averaged out over multiple years with a constant employer contribution. Administration costs are borne each year, and this is one thing that seems to be ignored terribly. Pension schemes seem to be very keen, pensions industry seems to be very keen to bulk up administration costs, which are borne ultimately by the employer in a DB scheme, by the employee or the member in a DC scheme. But the more members you have, the administration cost per member should decrease. When surpluses have developed by funding in excess of the level of benefits granted, as I've described, the surplus can be shared too, I think. The DB funding code. Yes, Barry Mack has just said that benefits can't be reduced in shared ambition scheme. That's correct. That's better for the employer. So yes, you have to. That depends on the level of benefits you're guaranteeing. If you give a low enough benefit against your aspirational benefit, then you're not restricting. Once they've been granted the discretionary evaluation, it can't be lost. And that's one of the reasons why we include the deferred members getting the discretionary annual revaluations, as well as the active ones. So, point. Does that deal with your question, Barry? Yep, thank you.
I think there's a thumbs up. Yep.
Yep. And then there's the positive effect on the company's accounts. You should be aiming to build up a balance sheet asset and not a liability by funding over the level of benefits granted. The current service cost is that DB cost of that is charged to the profit and loss account. Now that should reflect the constructive obligation for discretionary increases. But the P&L account will also reflect the interest on the surplus as a cost reduction or a reduction in interest charge from deficits. And there is no curtailment costs as long as the scheme remains open. Right. So the advantages to member. The annual pension is likely to reflect the efficiency of a DB pension scheme. I heard the criticism of the LCP's analysis of 50% greater this morning on the Value for Money podcast, but I think it is clear that a collective scheme is much more efficient than DC arrangements. If you follow that example through, the 8% minimum auto enrolment contributions into DC, if they would provide a 1/20th minimum rate DB pension, which our own analysis suggests at 31st of March 2024, suggests that's not an unreasonable relationship. The DC member is getting at 1/80th flat rate single life pension, as opposed to the 1/20th with inflation protection. The inflation protection and retirement, spouses and dependent benefits built in subject to the rules of the scheme, possibly ill health early retirement protection. And probably the most important thing is no decisions required to be made of the member. No investment decisions, decumulation decisions, And significantly, there's also no need to consolidate multiple DB pensions. So if I got a DB pension from one company and moves after say 5 years to another company and builds up another DB pension, then there's no particular advantage in having them combined. And indeed, the PPF level benefits, if they're less than 100%, may mean that it's advantageous to keep them separate. The flexibility of the funding, the 3 funding levels, should reduce the risk of benefit reduction on employer insolvency through the encouragement to build scheme surpluses. So, the whole thing works on the assumption that you're trying to build up a surplus in the pension scheme assets against the benefits, and you're then doling out the benefits as and when you feel the scheme can be achieved. And also the Pension Protection Fund does stand behind the employer's guarantee. And if you're in the scheme for longer, your annual revaluations and the additional service will quickly outstrip the 90% protection within a few years. And they're also likely to benefit from the with profits nature of the Shared Ambition scheme, both emotionally and financially, that they are going to receive benefits. Now, right, moving on to our actual experience. I've already said that Opened is sorry, I'm just reading Chris's. Yes, yeah. Yes, that's the very point I wanted to make, that Chris has put a note in the... Chris, do you want to ask your question and then I'll respond to that?
Yes, Peter. I just wanted to highlight the position over the discount rate. I mean, I'm in the camp that thinks that mark-to-market discount rates has been the real bugbear of the DB sector for, well, perhaps not the last 30 years, but certainly the last 15. Mm-hmm. And I think your chart shows very well that if we'd used the implied inflation rate rather than this very volatile gilt yield, then we would have had a much more stable situation. And I would be more open to the idea that perhaps surpluses weren't quite as transitory as they obviously have been.
Yes, we've been looking at that, and we have considered that. We basically, and I think Derek will be aware of this, for our 2009 valuation, which was one of the second valuation under the technical provisions, we said to the pension regulator, we don't think the gilt-based valuation model is appropriate for the scheme, and effectively they came back and said, yeah, well, you can use, say, an asset-based valuation model if you think it's appropriate, but we'll do our risk analysis purely on the gilt-based model. So that our attitude since then is we'll let the regulator play with the technical provisions valuation, and we'll submit what we have to do for that, but we'll actually manage the scheme against our expectations of long-term investment returns and long-term inflation rates, and not as you pointed out, the gilt market seems to have had a fairly stable view of the inflation rates, which challenged a bit in February, but I think that was probably just a market flip to do with the fact that the holders of index-linked gilts are different from the holders of fixed interest gilts. So that may have been, and it's sort of returned to normal at the end of March. And thank you to Con for providing updated information there. Since going back to the example scheme, the discretionary element is restricted to the accrued benefits prior to retirement. We have for both active and deferred. The pensions, we have got a discretionary power for pensions increased up to the RPI cap, but we're not targeting that at all. We're assuming they will just receive the appropriate minimum rate revaluation based on their service year. This has allowed the employer to maintain its employer's contribution at the final salary rate from 2003 to 2025. That was effectively 13.2% from the employer. The headline is actually 14%, but that's because the death and service benefit is separately funded. And 5% employee contributions. The members' benefits have then been matched to the available funding. So in 2012, but this was negotiated, we felt that we could no longer, within that level of contribution, expect to be able to fund the 1/60th of final salary, and reduced the accrual rate after consultation to 1/80th, that maintained the scheme open. And indeed, we provided zero rate pension revaluations between 2009 and 2019 for 10 years. We ended up at the end of that process, in 2018 valuation, with a break-even situation in terms of the technical provision valuation, so we didn't require allocation of contributions to deficit recovery. Therefore the company felt that the scheme was still not in a position to fund discretionary evaluation, so the company put in one-off contributions each year, depending on their business performance capability, and that was granted as a discretionary increase in that year. So that happened for 4 years. In fact, as looking at that chart, those additional contributions weren't actually required, and we could have granted the benefits at that rate, which just shows the long-term view you've got to take of the funding position. At the 31st of March 2024 valuation, we are now reporting a 171% technical provision funding rate and 136% on a solvency basis. The company accounts at that period report a pension scheme asset of £34.5 million, which happens to be 69% of the balance sheet total asset figure of the company. And the P&L pension cost reduced by the interest on the surplus, so it was a £1.3 million credit into the profit and loss account in that year. Looking at it now, we now realise that the company funding rate was now looking excessive. Investment returns have been good and consistently good, and even despite any sort of downturn in market values, as I say, they have good sides where there's net contributions going into the scheme, because the scheme has remained cash flow positive throughout. The company funding rate we were able to reduce it by 5% from the 1st of April 2025, which has enabled the company to more than offset its national insurance rise at that time, and that's not using any of the surplus. So, we're not. It's still funding for a level of benefit above the technical provisions. Members have benefited. They've received discretionary rate revaluations of 10% of the accrued benefits at the 1st of April 2024 and 1st of April 2025. And the scheme's funding strategy, we envisage future revaluations above inflation assumptions. We also get a one-off pension increase above inflation in 2025, just to certainly compensate for those ones. So we're in a very strong position. We are looking forward, and I'm just not sure what my next slide is, but I'll go into it. Right, we are in a very strong position now, and we're looking forward. And so the first lesson that we learned is don't rely on the technical provisions discount rate as an assumption about future investment returns. And we are sort of now looking at the technical provisions valuation and saying, hold on, with current 20-year gilt yield, which is probably our median, of 5.3%. Are we? Is that being optimistic about our investment return? When you look at the dividend yield on the MSCI World Index, 1.9%, and is that going to grow with what rate of inflation? I think I've got another question. Do you want? Asking, can employees pay the contributions via salary sacrifice? No. What we is the simple answer. We didn't set that up at the scheme outset, and we have got a DC AVC scheme to sit alongside. So the employees, so the employer is we and the value of salary sacrifice. We looked at it from time to time, but decided not to put that to the company as a suggestion. And I'll come on to that point in a moment. If I could just cover the next points, and I'll come back to that. Be careful not to create a constructive obligation. So when we set up the scheme, and again in 2012 when we changed it, we made it very clear to employees that a zero rate revaluation was possible, and indeed at the time was the norm, if you like. So we didn't create any expectations that they would have a certain level of revaluation each year. And I think that is good, and that is why we've actually moved from viewing increases in terms of inflation measures, whatever they may be, to a sort of profit share percentage rather than that, so that perhaps that's better understood that may be more or less in years. So create a constructive obligation to that point. But the important thing is that there's to be an open and constructive dialogue between the employer and the trustees about the. Now, we're very fortunate in this particular company in that it's a not-for-profit organisation for whom the workforce is a significant stakeholder. So that probably has the thing. It also has a reasonably strong, well, it has a very strong financial structure. But equally, we've got a very strong board of the company. The chairman of the company is also the chair of a trust, another completely different trustee board. So we have discussions with them. I attend the main board meeting once a year to discuss these issues. And always err on the side of caution. Right. I have an unfortunate. Right. What about in dialogue between employer and employees? The employer, it's an interesting one. We have gone through that process, and this is where we perhaps differ from people like USS thinking about it's seen as being in the gift of the, it's a joint discretionary power, the trustees and company agreeing, and if either party disagrees, then they have a right of veto. It is seen more as a gift out of that process, so there is little dialogue on the revaluations as such. It's seen almost as like a bonus, if you like. So, is that sort of question instantly? Right. Moving on, just a couple of final things is aim to build the surplus by maintaining cash funding above technical provisions current service cost. So just keep building a buffer and maintain that buffer. I think that is very important, but the company gets the benefit of that in terms of the assets on the balance sheet, which is isn't subject to an asset ceiling cap, and also by the interest credit to the profit and loss account. And the final message is don't anticipate legislation or regulations. Unfortunately, we slightly misanticipated what would happen under auto-enrolment and set up we previously contracted out on a money purchase basis for this benefit. And we thought that when we were reviewing the benefit structure, we thought auto-enrolment would probably work on that basis, that you could have a minimum contribution of 8%, and you could, provided we provided a money purchase underpin benefit, which didn't exist in the legislation when it came out, and is now creates a real problem in terms of administration costs. In fact, very few people, or no people, are anticipated to benefit from it. Even when there were zero revaluations to the main scheme benefits, the money purchase underpin was only basically applied to short service employees who left employment at a young age, because it anticipated the growth of the fund, which increased more rapidly than the deferred pension increase. But since we've been providing revaluations at the 10% level, or indeed above minimum rate revaluations, that has fallen away. But the actuary now has to do the calculation for both scheme valuations and indeed for transfer values on the dual basis. So it's very costly, that. Right, that concludes my session. All right, yeah, sorry, I'll stop sharing. So I've talked for nearly an hour. Would you like to any comments, any experience? Bob's got a question. Mm-hmm.
Bob, do you want to?
Yeah. I'll just come back. Yeah, Peter, very interested in what you're saying. Back in early 2000s, I had one client who was particularly struggling. They had a 6 years final salary pension scheme contracted out, which they could not afford. There was a massive deficit. We'd spent a number of years trying to debate with the TPR and about the pension fund levy, where at one point the levy was greater than the deficit contribution the company's having to pay, which led us to trying to renegotiate how the PPF levy was actually applied to companies where there was a serious covenant risk. But we tried to find a way of actually getting out of the problem, and we came up with a cash balance scheme, which is a revalued career average based on 10% of salary, literally funded by an employee salary sacrifice of 5%. And that actually ran for about 3 years quite well, until a change of directors changed their way of operating, and eventually the company went to the wall. But it was a way of trying to get out of a problem. And had the company carried on, had it been successful, the ambition was to pay a cash benefit of twice the original scheme benefit. And that's to get around the problem of guarantees. I had to remove guarantees from a pension promise, basically. But it was difficult, and we were able to get the message across to the membership because they're all highly intelligent people. They're all engineers in the company, and they want to see the company survive. So you had to have the employer and the membership working hand in hand to get that moving. So, Peter, what you've done, I think, is brilliant for the scheme you've actually achieved, but it is complicated.
Yes, I think it is. If we're talking about, I don't think employers are likely to want to set up a shared ambition scheme from scratch now.
I agree.
I think
time has gone on.
My target audience is, in fact, those that have an existing DB scheme still in existence, which they haven't completely bought in or bought out, and whether they can leverage off that for benefits, and by reopening a new section on a shared ambition basis. I think that probably is the most likely target group. But yes, it's not the only model, and I'll invite. I was going to sort of invite Derek to contribute again and sort of say whether this was how he imagined it would work. And
yeah, Derek, if you want to unmute, that'd be great, and then we can come to Con, for he's got his hand raised. So.
Okay. Yes. So thank you for your presentation, Peter. If I revert back to when you were remarking on valuation discount rates and using a gilt yield isn't terribly helpful. So in the ideal world, I think valuation discount rate should be based on the rate of return expected on the assets. So in accountant speak, or indeed financial mathematics speak, the internal rate of return, the rate of return that discounts the income expected from an asset to equate the value of the income to the asset's market value. And that kind of discount rate is a much better basis of planning the funding of a pension scheme. You are literally comparing the income on the assets with the outgo on the benefits for a fair projection of the scheme. And I think I was initially advising the scheme you were talking about and valuing the scheme on that basis. But when I ceased to advise the scheme and the replacement actuary advised on a gilt yield discount rate basis, I think it's fair to say that the outworking of the scheme depends on how the actuary advises on it. And I was interested in your remark about how you now view the scheme as a sort of a with profit scheme, as opposed, and you base your thinking about annual increases thinking in nominal terms rather than an inflation target terms, just sharing the experience. So I think sort of, this alludes to how you think about the planning of the scheme. Is any surplus accruing to the members, because what you're trying to do is fix the employer's contribution rate. In your scheme, that's not what's been done. The employer's contribution rate has varied to some extent. There's been some sharing of surplus with employer and employees. That's one entirely valid way of thinking about it. There's another way of thinking about it, which is to try and hold the employer's contribution rate more constant and sharing surplus with members, or accruing all surplus to the members through the annual increases, as opposed to a different way of thinking about it could be, you talked about it as sort of a with profit. So rather than thinking about the surplus in the scheme, you think about perhaps, let's say, how have the assets outperformed or underperformed, and share some asset performance with the members and with the employers with their contribution rate. But what you're not doing is sharing the whole surplus or even thinking in surplus terms, just thinking in experience terms. Has experience been positive or negative? Share positive experience through the annual increases. So the various ways of thinking about it, I think there's a lot to be said for consistency over time, for establishing a policy which looks sound at the outset. Of course, policies need editing with changing experience and changing outcomes, but by and large, seek to keep your policy constant and make gradual change over time. I think those are all good principles. But I think the math of your scheme and the current high surpluses using gilt yield discount rates after the rise in the gilt market suggests, different thinking and different actuarial methods, different actuarial advice. Maybe the scheme could have given more increases in the past than it has done.
Yeah.
But the money's still there. The money always was in this scheme rewardingly invested.
Yes.
And therefore the money is there to spend on the members, even if they've had to wait for it for a while, for the increases to eventually start to be awarded in your scheme. So I think that is where I'll finish. That no matter how one might critique the actuarial advice or critique the trustees, how the way they've awarded the increases, what the shared ambition scheme has enabled is an open scheme, so people are still getting benefits.
Yeah.
New recruits are still getting these benefits, and it's enabled a rewardingly invested scheme, so they're getting those benefits affordably to both members and the employer. So I think that's a positive note on which I'll end. And the actuarial management, the trustees management, and getting the employers buy-in, that's all detailed compared to the principle of here's an open scheme that's cost effective.
Right. Yes, I agree with you. Right, Con, would you like to come in with that?
Yes, a simple little comment, really, Peter. I think that if you want to get this more widely talked about and understood, that you should go and talk to the Association of Corporate Treasurers.
Right. Okay. I'll welcome an email with a contact, and I'm more than happy to do so. Thank you.
My next door neighbour worked for the Association of Corporate Treasurers, Peter, so I'll get you some contacts.
All right, thank you very much. Perhaps you can, yes, I'm more than happy to do that sort of promotion role, if you like. Barry Mac.
JQ is next, I think. JQ.
Yeah, hi. I'm going to be a little bit more hard-hitting on this, I think. If the FCA looked at a private entity that was offering something of this nature under Consumer Duty umbrella, it would have seen benefits reduced by 25%. It would have seen employer contributions reduced by 38%. And it would have seen, frankly, a little bit of loosey-goosey on the sharing piece. And the question I have is, deep down, and it may well be that it's the nature of the business that facilitate this, because it's not for profit. I generally struggle to see the one person's freedom is someone else's ability to frankly abuse, and that there is a weakness in the system we have, but there is a strength in it as well.
Yes, I mean, yeah, I mean the fundamental issue is you have this guaranteed level of pension benefit, and is that more or less than fair, and is that encouraging the employer to fund more than he would fund?
I don't know, but I mean, a 25% reduction from 60th to 80th is significant within a very short time period.
Yes. Yeah,
and that's not necessary. That doesn't reflect stability.
No.
And an employer contribution from 13.2 to 8.2 doesn't reflect stability either. So that's the. I'm questioning whether we're eating our own cooking here.
Yeah, I mean, yes, we're very conscious of those issues, and I say this is a sort of joint consultation between the employer and the trustees. So, and that we're in a very fortunate position there. So, I would say that. But I would also say that the contribution rate by the employer was set at a very high level because of the deficit on the final salary scheme.
Okay.
So,
Okay.
so that's and
That
indeed
explains it.
that's the original 13.2% was including a deficit recovery element in that.
Okay.
So, so
Thank
it's
you.
not quite as dramatic as you look at it. One other thing that Barry Mack has put in the chat is about deal with the issues of younger generations subsidising the older generation. Yes, that's something we have considered, but the employee contributions is 5% at whatever, which is the minimum, the auto-enrolment minimum contribution. So whether they were into a DC scheme or a DB scheme. So the question is, do they get better benefit? Do they get the benefit in the outcome? And that is one of the reasons why we're comfortable, I should put it that way, around with the deferred members getting the discretionary increases the same as the active employees. That their ultimate pension benefit is enhanced during the period between the service, whether they remain in service or move on. So they do get benefits. So we have sort of.
It's such an interesting.
Intellectually, the interest.
Yeah. Oh, Peter, thank you so much for your presentation, and we have overrun, but it's a very interesting, scenario. I will go offline, Peter, and talk to you about the ACT. That's a good idea, Con. And are you happy to send us the slides, Peter? Can we use those slides, or are they confidential? Yeah, if anybody wants the slides, please come to me or Henry, and we'll send you the slides.
And yes, I'll do that later today.
Thank you very much. Yeah.
I've got to edit it out slightly for doing so, because I've got some
fine.
random additional slides.
Yeah. So I'm hoping you'll all thank me and join me in the digital clapping or actual clapping for a great presentation. Good to be challenged and good to think about the alternatives for the future. And some people could join an open scheme with certainty of some benefits, Peter, which is better than DC in some people's book. So there you go. It's got legs, I think. So there we are. So thanks for today, Peter. The video will be up this afternoon. And I wish you well for the rest of the week. And that was very, very interesting. Next week, I think we've got in conversation with somebody which I can't name yet. A bit like you, Peter, I've got to be a bit cagey, but should be a good in conversation with. So join us next week for Pension Playpen. But enjoy the rest of your week. Enjoy your Easter weekend. Don't have too much chocolate. Let's pray for peace in the East. Let's pray that Trump drops tariffs as well. So there we go. That's a new one.
And a happy Easter to you all.
Thank you very much, Peter. All right, take care. Bye, everyone. Cheers. Bye.